Looking to invest in a business that keeps putting up amazing numbers? Want a yield that beats the market and dividend growth that's in the double digits? Interested in buying a high quality dividend growth stock on sale after it's seen its price crater by more than 40%? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a leading home furnishings retailer. Retailing is a tough game. I think of retailing as a grind that filters out the weak. Only those businesses that are truly special can rise to the top, scale, and make serious money. Well, this retailer is truly special. And that is why it continues to grow its revenue, profit, and dividend like clockwork. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Williams-Sonoma Inc., which appear to be trading at a significant discount today. Williams-Sonoma Inc., stock ticker WSM, is a multi-channel retailer of high-quality home products and furnishings. Founded in 1956, Williams-Sonoma is now an $8 billion by market cap retail barbarian that employs over 16,000 people. The company's reporting segments break down by brand. Pottery Barn, 38% of fiscal year 2021 sales. West Elm, 27%. Williams-Sonoma, 16%. Pottery Barn Kids and Teen, 14%. Other, which includes international franchise operations, accounted for 5%. Almost all of the company's sales are US-based. In my view, the modern-day retailer needs to master two abilities. Differentiation is one of those abilities, and a coherent and cohesive omni-channel strategy is the other. Williams-Sonoma excels at both of these. First, Williams-Sonoma sets itself apart by providing unique brands within a specialized niche. The company sells a range of high-end home furnishings that still offer a great value proposition relative to the quality. Second, Williams-Sonoma has been arguably better than any other retailer out there in terms of managing channels. Here's what the company has to say about this in their 2021 annual report, and I quote, "Our e-commerce channel has been our fastest growing business over the last several years and represented more than 65% of our net revenues and profits in fiscal 2021, unquote. This isn't some new pandemic-related story either. Williams-Sonoma has been generating 50% plus of its sales through their e-commerce channel for years. The fact that Williams-Sonoma has been so prolific at managing their channels is what positioned them so favorably for the pandemic. At the same time, the company uses beautiful physical retail stores to showcase their products in their best light. With the sudden rise in the work from home trend playing out and with home renovations still occurring at a rapid clip, Williams-Sonoma has seen their foresight and planning over the years paying off. Because the company has mastered the two abilities I touched on earlier, Williams-Sonoma is thriving in an environment where many traditional retailers are struggling to survive. And I think they'll continue to thrive, which should allow the retailer to continue growing its revenue, profit, and dividend for decades to come. Already, the company has increased its dividend for 16 consecutive years. Notably, that time period runs through the Great Recession, which severely impacted the US housing market. I think this shows just how durable this business and its dividend is, which bodes well since another serious slowdown in the US housing market is upon us. The 10-year dividend growth rate is 13.6%, and there's been no market deceleration in dividend growth either. Along with this double-digit dividend growth rate, the stock offers a market-beating yield of 2.5%. This yield, by the way, is 10 basis points higher than its own 5-year average. With With a payout ratio of only 19.5%, this appears to be an extremely secure dividend even in the face of a tough housing market. I like dividend growth stocks in what I call the sweet spot, a yield of between 2.5% and 3.5% supported by high single-digit or better dividend growth. The yield barely qualifies, but the double-digit dividend growth rate more than makes up for that. It's hard to find anything to complain about here regarding the dividend metrics. Looking at business growth, Williams-Sonoma raised its revenue from $4 billion in fiscal year 2012 to $8.2 billion in fiscal year 2021. That's a compound annual growth rate of 8.3%. Strong top-line growth, but I think we have to keep in mind the last 2 fiscal years have seen an explosion in sales. If we back things up a bit, we can see that Williams-Sonoma was compounding its revenue at an annual clip of approximately 6%. Still solid, just not quite as impressive. Meantime, earnings per share grew from $2.58 to $14.75 over this period, which is a compound annual growth rate of 21.4%. Truly exceptional. Who would have predicted a home furnishings company would put up tech-like earnings growth? Again, though, if we back up to just before the pandemic, EPS was compounding at an annual rate of between 9% and 10%, and that's where I'd be baselining my growth expectations for the business. Margin expansion and copious share repurchases help to drive this excess bottom line growth. For context around the repurchases, the outstanding share count has been reduced by approximately 25% over the last decade. Looking forward, CFRA is projecting that Williams-Sonoma will grow its earnings per share at a compound annual growth rate of 20% over the next 3 years. In my estimation, that's an awfully aggressive forecast. Then again, Williams-Sonoma's most recent quarterly report, which is Q2 for fiscal year 2022, showed 20.6% year-over-year EPS growth, so there's no apparent slowdown in this train. On the other hand, we haven't seen the full effects of rising rates and the related softening in the U.S. housing market work its way into the company's results. There's a lag here. Now, I'm not forecasting doom and gloom. To the contrary, Williams-Sonoma is a wonderful business that is poised to do very well over the coming years. It's just that I'm not sure if they can keep up the torrid growth rates of the last couple of years. I'd be pleasantly surprised if Williams-Sonoma compounds its earnings per share at a 20% annual rate over the next 3 years, but even if they fall far short of this level and come in closer to something that resembles their pre-pandemic norm, that would still be enough to power the kind of dividend growth that's roughly in line with what's transpired over the last decade. And coupling a double-digit dividend growth rate with a 2.5% starting yield is a highly compelling mix. Moving over to the balance sheet, Williams-Sonoma has a pristine financial position. The company has no long-term debt. Management has been a great steward of capital. This gives the company a lot of financial flexibility in terms of funding internal growth, buybacks, possible M&A, and dividend increases. Also, Williams-Sonoma's lack of debt protects them from what could otherwise be a headwind from rising rates. Profitability is robust, especially for a retailer. Over the last 5 years, the firm has averaged annual net margin of 8.3% and annual return on equity of 43%. Coming back around to the margin expansion story I touched on earlier, the company was printing net margin in the 6% range 5 to 10 years ago. Fundamentally speaking, this is an extremely high-quality business. And with brand strength, a successful omni-channel strategy, economies of scale, and vertical integration, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. While I see regulation and litigation risks as relatively low in this particular industry, Williams-Sonoma has to deal with fierce competition. The lack of switching costs is a risk, although the company's brand recognition around quality products does mitigate this risk somewhat by creating a more loyal customer base. There is exposure to the housing market and the cyclicality that brings. If home sales fall, demand for luxury home furnishings should decline. Ongoing kinks in the global supply chain could weigh on near-term results. The company also faces volatility around input costs. I think it's important to carefully consider these risks, but quality and valuation should also be carefully considered. The latter point is key, with the stock looking attractively valued after seeing its price crater by more than 40%. The stock's PE ratio is 8. Yes, it's a single-digit PE ratio. That's significantly lower than the broader market's earnings multiple. It's also meaningfully lower than its own 5-year average PE ratio of 15.4. The price-to-cash flow ratio of 7.3 is also noticeably lower than its own 5-year average of 9. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. Now, this is as high as I'll I'll go with a long-term dividend growth rate, but I think a company of this caliber deserves the benefit of the doubt. This rate is lower than the demonstrated long-term growth across both EPS and the dividend, and with the expectation of more double-digit EPS growth to come, I don't see my mark as aggressive. We also have to keep in mind that there's no long-term debt on the balance sheet, plus the payout ratio is low. If anything, Williams-Sonoma is positioned to exceed this model's dividend growth rate, but I'd rather be pleasantly surprised than surprisingly disappointed. The dividend discount model analysis gives me a fair value of $168.48. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Williams-Sonoma as a 5-star stock with a fair value estimate of $230. CFRA rates Williams-Sonoma as a 2-star sell with a 12-month target price of $135. It's odd to see Morningstar and CFRA so far apart. It's also odd that CFRA takes this stance with a rosy growth forecast and a target price that's higher than the current price of the stock. Nonetheless, I came out somewhere in the middle. Averaging the three numbers out gives us a final valuation of $177.83, which would indicate the stock is possibly 39% undervalued. Here's the bottom line, guys. Williams-Sonoma Inc. is an extremely high-quality business with excellent fundamentals, including a pristine balance sheet. It's about as good as a retailer can get. With a market-beating yield, double-digit dividend growth, a low payout ratio, more than 15 consecutive years of dividend increases, and the potential that shares are 39% undervalued, this is a gem for long-term dividend growth investors. And now for a special news announcement. Johnson & Johnson, stock ticker J&J, has come out and named its consumer health spinoff Kenvue. Not a big fan of the name, but this spinoff is a potential catalyst in terms of unlocking value, and it also isolates the bigger part of the business from some litigation risk. I named Johnson & Johnson one of my top 5 dividend growth stocks for 2022. The stock is roughly flat this year, but with the S&P 500 down more than 20% year to date, that's a ton of relative outperformance from J&J. If you haven't already loaded up your portfolio with this blue chip healthcare conglomerate, now might be a good time to consider doing just that. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It'll allow me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.